So what if I told you the IRS has a loophole that literally pays you for your losing trades? I know, it sounds way too good to be true, but it's not. You see, there are these hidden rules to investing that can seriously boost your returns, but almost nobody talks about them. Today, we're diving into one of the most powerful ones out there, tax loss harvesting. And trust me, this isn't just about damage control. It's about turning your losses into a real strategic advantage, one that the pros use year after year. Let's get into it.
You really have to start right here with this quote from David Einhorn. It's absolutely brutal, but it is so painfully true. I mean, we've all been there, right? You buy something, it dips a little, you hang on thinking, oh, it'll bounce back, and then it just keeps on sinking. It is a gut-wrenching feeling, and it's how a tiny mistake snowballs into a portfolio disaster.
So, that's the big question, isn't it? Why? Logically, we know we should cut our losses early, but we just don't do it. Why do we sit there and watch a small paper cut bleed out until it's a massive wound? Well, that question gets right to the very core of our psychology as investors.
And that leads us straight to the heart of the problem, which we can call the investor's deepest hole. This is that fundamental mistake that can basically dig your portfolio into a grave that it just can't climb out of.
You know, it really all comes down to this one simple piece of wisdom, the law of holes. If you're in a hole, the first most important thing you can possibly do is to just stop digging. And think about it, every single day you hold on to a bad investment, whispering it'll come back, you're just grabbing the shovel, throwing more dirt over your shoulder, and making that hole even deeper.
And here's the thing. This has nothing to do with spreadsheets or logic. It's 100% emotional. Clicking that sell button on a losing trade feels like you're admitting you failed. It makes that loss real. So to avoid that sting, we just hold on. We put off the pain. And by doing that, we let a small, fixable mistake fester into a catastrophic blow to our finances.
Okay, fine, we get it. We need to stop digging. But it's not that simple because there's this hidden cost to selling. And this brings us to the next phase, the agitation. This is the part where doing the right thing still feels kinda awful.
So, here's the classic investor's dilemma. You finally decide to do the smart thing, maybe sell a winner to rebalance a bit, and what happens the second you do? The taxman shows up with his hand out. The moment you sell, your profit becomes real, and that profit is taxable. And that creates this huge incentive to just, well, do nothing at all.
And the difference in how you're taxed is just staggering. Look, if you hold something for less than a year and sell it for a profit, you're taxed at your normal income rate. That's the highest rate you pay. But if you can just hold on for more than 1 year, suddenly you qualify for these much lower long-term capital gains rates. That difference, that tax drag, can act like a giant anchor on your growth.
Let's make this real. This example shows it all. You've got two investors. Both start with 50 grand, both earn a solid 10% a year. But investor A is constantly trading, paying those high short-term taxes every single year. After 20 years, they have about $181,000. Now look at investor B. They just buy and hold for 20 years. They end up with over $290,000. That's $100 grand difference. Just gone, eaten up by taxes. It completely changes your financial future.
So it feels like we're totally stuck, right? You get punished for holding losers, but you get punished with taxes for selling winners. It's a lose-lose. But what if there was a way to actually use the tax code to our advantage? This, right here, is the aha moment. This is the first solution, a surprising tax loophole. Okay, this is the one rule you have to burn into your brain. It's called the wash sale rule. Basically, the IRS figured out that people would try to cheat the system. You know, sell a stock on December 30th to get a tax loss, then buy it right back on January 2nd. So they created this rule. If you sell for a loss, you can't buy back that same thing or something substantially identical for 30 days. And if you mess this up, even by accident, your loss is disallowed and the whole strategy is worthless.
Okay, but here's where it gets really interesting. Did you notice the specific language? The rule says substantially identical security. That word, security, is doing all the work here. What if some of the things we're investing in aren't technically considered securities?
And there it is. That's the punchline. For stocks, bonds, ETFs, all that stuff, yep, they're securities. The wash sale rule is in full effect. But cryptocurrencies, right now in the US, the IRS treats them as property, not securities. And that means the wash sale rule, well, it just doesn't apply. This is a massive, game-changing advantage for anyone who invests in crypto.
So how do you actually use this? It's almost shockingly easy. Step 1, you sell your crypto that's in the red.
Step 2, literally 1 second later, you buy the exact same amount right back. You've kept your exact same position in the market. Step 3, you have now officially harvested a capital loss. You can take that loss and use it to cancel out gains from other investments, like stocks. It's like turning your losing trade into a discount coupon for your tax bill.
Now, for stocks, you can still play this game, you just have to be a bit more clever. It's a strategy called sector swapping. Let's say your Ford stock is down. You can sell it, lock in that tax loss, and then immediately buy, say, a broad auto sector ETF. See what you did? You're still invested in the auto industry, but an ETF with hundreds of stocks is not substantially identical to just Ford stock. So you get to claim the loss while staying in the market. It's a fantastic workaround.
Look, tax loss harvesting is an amazing defensive tool, but it's just one part of the bigger picture. To really build a portfolio that can handle anything the market throws at it, you need a full suit of armor. So let's zoom out a bit and talk about the broader solution, portfolio armor.
All right, I'm going to throw a fancy word at you, ergodicity. Don't worry, it's simpler than it sounds. All it really means is building your strategy so that you never risk going to zero. Think about it. A 15% loss stings, but you can come back from it. 100% loss? Game over. You're wiped out. An ergodic strategy is designed specifically to make sure you never, ever hit that point of no return.
So what does this armor actually look like? Well, there are a bunch of tools, things like hedging or investing in assets that zig when the rest of the market zags, like the VXX Volatility Index. You can use automated tools like trailing stop losses to take the emotion out of selling. And, of course, there's good old-fashioned diversification. The whole point is to build systems that protect you from that worst-case, game-over scenario.
So defense is absolutely critical. Rule number 1 is don't get wiped out. But once your defenses are solid, it's time to go on offense. It's time for the ultimate solution, hunting for true alpha.
So what in the world is alpha? Simply put, it's the part of your return that comes from skill, not from luck, or just a rising market. You know, anyone can look like a genius when everything's going up. I love this analogy. A reckless driver might get to the destination fast, but it was luck. A skilled driver gets there safely because of repeatable actions. Alpha is that skill. And in a weird way, tax loss harvesting is a form of tax alpha, a skillful move that boosts your real return.
And this is where we come full circle. You've probably heard the saying, the best defense is a great offense. And in investing, it is absolutely true. And that great offense isn't about frantic day trading. It's about doing the hard work to find incredible companies selling at reasonable prices, and then having the patience to hold them for the long haul, letting them compound your wealth while you get those sweet, sweet lower tax rates.
I want to leave you with something you can actually use. It's a quick and dirty rule of thumb from the father of value investing himself, Benjamin Graham. You take a company's price-to-earnings ratio, which is what you're paying for their profits, and multiply it by its price-to-book ratio, what you're paying for their assets. If the answer is less than 22.5, that's a signal. It's not a buy signal, but it's a signal that this company might be undervalued and is worth looking into. It's a great starting point for hunting that alpha.
So we have covered a lot of ground here. We've talked about the psychology that makes us our own worst enemies, the weird rules in the tax code, and how to build a portfolio that can actually last. You now know how to stop digging yourself into a hole. You know how to play defense. But that leaves us with one final question to think about. Now that you know how to avoid losing, do you know how to win?